Last week, Harry sent me a screenshot. His Excel spreadsheet. His retirement plan. $500,000 saved by 45. Some dividend ETFs paying 4%. Done. Financial freedom. I stared at his message for a full minute before typing back, "Harry, we need to talk." See, Harry's not alone. Every day someone watches another YouTube video promising the same dream. Live off dividends forever. Never touch your principal. Passive income while you sleep. It sounds perfect. It sounds easy. It sounds like everything Wall Street doesn't want you to know. But here's what those videos won't tell you. Harry's plan requires something nobody mentions. A number so big, most people's dreams die the moment they see it. Today, I'm showing you that number. And then I'm showing you what actually works, with real ETFs that crushed it this year. Let me start with what dividend investing does brilliantly. It generates predictable income. When markets crash 30%, your dividend checks keep coming. When everyone else is panic selling, you're still getting paid. That psychological comfort? It's real. I've watched retirees sleep through market crashes because Johnson & Johnson still sent their quarterly check. Because Coca-Cola kept paying like they have for 61 years straight. These aren't penny stocks. These are empires. Companies that have raised their dividends every single year for decades. Through recessions, through wars, through pandemics. The dividend kings, they call them. And when you own them, you feel untouchable. Warren Buffett owns $25 billion worth of Coca-Cola stock. It pays him $704 million in dividends every year. He hasn't sold a share since 1988. That's the dream, right? That's what Harry wants. But here's the first truth bomb. Buffett doesn't pay a dividend from his own company, Berkshire Hathaway. Zero. Nothing. Why? Because he knows something about dividends that changes everything. The decision to pay dividends rather than retain earnings, Buffett once said, often means management has run out of good ideas. Think about that. The greatest investment portfolio builder of all time doesn't pay dividends because he'd rather compound the money internally. But that's not even Harry's biggest problem. Harry's biggest problem is math. Cold, brutal math. To generate $100,000 in annual dividend income at a 3% yield, which is realistic, sustainable, you need $3.3 million invested. $3.3 million. Harry has $500,000 planned. At 4% yield, he'd get $20,000 a year. That's $1,666 per month. Can you retire on $1,666 per month? This is where the YouTube dream meets reality. And reality doesn't care about your dreams. Most people will never save $3.3 million. That's not pessimism. That's statistics. The median retirement savings for Americans aged 65 to 74? $200,000. Not $3.3 million. $200,000. At a 3% dividend yield, that's $6,000 per year. $500 per month. That's not retirement. That's a car payment. But wait. There's another problem nobody discusses. Dividends aren't guaranteed. In March 2020, companies you thought were bulletproof started cutting dividends. Disney suspended theirs completely. Shell cut theirs for the first time since World War II. Even dividend aristocrats, companies that had raised dividends for 25+ years, started falling. Your safe income? Gone overnight. And here's where people make their fatal mistake. They chase yield. They see an ETF paying 8%, 10%, even 12%, and think they found the Holy Grail. Let me show you why that's dangerous. But first, let me show you what actually works, starting with an ETF that returned 27.95% this year. Quick reality check. If you're finding value in breaking down these actual numbers, hit subscribe. I analyze real performance data every week, not YouTube fantasies. Start with SCHD, the Schwab US Dividend Equity ETF. Current yield, 3.41%. But here's what matters more. Year-to-date return of 27.95%. This isn't sexy, but look at the data. While growth stocks crashed in 2022, SCHD barely flinched. The fund focuses on quality, companies with strong financial planning, consistent earnings, sustainable dividends, top holdings, Lockheed Martin, AbbVie, Coca-Cola, defense contractors, pharmaceutical giants, consumer staples. Boring? Yes. Reliable? Absolutely. That's your foundation. But it's not enough alone. Next, I'm revealing something interesting. VIG, Vanguard Dividend Appreciation ETF. Year-to-date return, 24.19%. Lower yield at 1.73%. Wait, Harry says. 1.73%? That's nothing. Wrong. VG doesn't chase current yield. It chases dividend growth. Companies that have increased their dividends for 10-plus consecutive years. Microsoft up 14% in dividends. Apple up 4.3%. United Health growing payouts annually. These aren't just paying you today. They're paying you more tomorrow. Your income stream isn't just stable, it's growing faster than inflation. That's how you build long-term wealth building. The data proves it. VIG's 10-year average return beats most high-yield funds. Now here's where most people screw up. They see VNQ, Vanguard Real Estate ETF, and load up. Current performance? Up 8.17% year-to-date. Yield? Around 3.8%. REITs have to pay out 90% of income as dividends. Sounds amazing, right? Wrong again. Here's what they don't tell you. REITs are interest rate sensitive. The Fed's been cutting rates, that's why VNQ's up. But when rates rise, REITs dive. 2022, VNQ dropped 26% while SCHD held steady. Your 3.8% yield doesn't matter when your principal drops 26%. Plus, REIT dividends are taxed as ordinary income, not qualified dividends. Your 3.8% yield becomes 2.7% after taxes. Still interested? Here's the one nobody talks about but crushed it. VYM, Vanguard High Dividend Yield ETF. Year-to-date, up 28.16%. Yield, 2.58%. 443 holdings. Maximum diversification. Minimum drama. When JP Morgan struggles, ExxonMobil carries. When energy dips, financials rise. Top holdings include Broadcom, up 110% this year, JP Morgan, ExxonMobil. This is your asset allocation play. Spread the risk, capture the upside. Time for the growth play. DGRO, iShares Core Dividend Growth ETF. Year-to-date, 25.34%. Yield, 2.13%. Even lower yield. Exactly. DGRO owns companies in their dividend adolescence. Microsoft, Apple, JP Morgan, still growing, still building. 5-year dividend growth rate, 10% annually. This is your compound interest machine. Lower yield today, explosive income tomorrow. And now, the surprise winner, HDV, iShares. Core High Dividend ETF. Year-to-date, 25.51%. Yield, 3.18%. Concentrated in energy and healthcare. ExxonMobil, Chevron, Johnson & Johnson. When oil rallied this year, HDV rallied. But remember, concentration means risk. Energy crashes? HDV crashes. Use it tactically, not as your core. Want these ETF breakdowns with real-time data every week? Drop a comment below with which ETF surprised you most. I read every single one. Now here's how Harry actually fixes his plan using these real performers. Forget living entirely off dividends. That's YouTube fantasy. Build a pyramid with this year's winners instead. Base layer, 40%. SCHD and VYM. Your steady income generators averaging 3% yield with 28% returns this year. Middle layer, 30%. VIG and DGRO. Your growth engines. Lower yield but crushing returns, both up 24+%. Upper layer, 20%. Growth stocks, no dividends. Yes, really. Nvidia up 171% this year. You need this growth. Top layer, 10%. Cash and short-term bonds. Your emergency fund. Your flexibility. This is tax-advantaged accounts optimization at work. With $500,000 invested this way, Dividend income, approximately $13,000 per year from dividend layers. Portfolio growth, based on this year's performance, you'd be up $125,000 plus dollars. Total return potential, way beyond living off dividends alone. Now add Social Security, maybe some part-time consulting, a small rental property. Suddenly, Harry's plan works. Not because dividends saved him, because he stopped believing dividends were everything. Here's what else nobody mentions about dividend investing. Congressional trades show interesting patterns. Nancy Pelosi's recent Microsoft and Nvidia positions? Zero dividend plays. She's chasing growth, not yield. Institutional money? BlackRock increased SCHD holdings 8% last quarter. They're not chasing 10% yields. They're buying quality at 3%. The smart money knows. Investment strategy isn't about maximum yield. It's about total return. Look at today's actual performance data. AT&T, 6.41% yield. Stock down 30% from 5 years ago. Altria, 7.91% yield. Stock flat for a decade. Meanwhile, Microsoft with its 0.7% yield, up 400% in 5 years. Which would you rather own? Even aristocrats fall. GE paid dividends since 1899, then cut to a penny. Your financial independence can't depend on any single income stream. The real secret about dividend investing isn't the yield. It's not the tax advantages. It's not even the passive income streams. It's this. Dividends are just one tool in your wealth-building toolkit. Use them wrong, like trying to live entirely off dividends with less than $3 million, and they'll break. Use them right, combining this year's winners like SCHD, 27.95%, VYM, 28.16%, and VIG, 24.19%, and they're powerful. Harry doesn't need $3.3 million. Harry needs a better plan using ETFs that actually perform. Start with these 6 funds. Build the pyramid. Add other income streams. Most importantly, stop believing the YouTube fantasy. Because the truth about dividends isn't that they don't work. It's that they don't work alone. And once you understand that, once you see these actual returns, you're already ahead of 90% of investors chasing yield into poverty. Your money management isn't about finding the perfect dividend stock. It's about building a system that pays you multiple ways. That's how you actually retire. Not with dividends alone, with intelligence and data. Harry messaged me back yesterday. So these ETFs really returned 25+% this year? Yes, I told him, while everyone else chased 8% yields that went nowhere. He's rebuilding his spreadsheet now. Same $500,000. Different strategy. Real strategy backed by real performance. The kind that actually works when dreams meet data. The kind nobody tells you about. Until now.